Amateur investors often evaluate a stock based solely on its product, acting as if the business operates in an isolated vacuum. In reality, corporate performance is easily shattered by forces completely outside a CEO's control. The foundation of all economics is scarcity. Because land, labor, and capital are inherently limited, every participant in the global market is locked in a continuous competition over how to allocate them. This maps the circular flow of income. Households supply labor, and firms supply goods, creating a continuous loop. Widening the view reveals the system's vulnerability. It is open, relying on constant injections like investments, while subject to leakages like taxation. Because no asset exists in isolation, looking under the hood of a single company isn't enough. You must first map the macroeconomic ocean it swims in. At the widest point of the analytical funnel sits the macroeconomy, governed by institutions like the Federal Reserve. These central banks dictate the climate of the entire global market. Central banks manage a nation's fiat currency. They control the total money supply through specific levers, adjusting interest rates and executing open market operations to determine exactly how much liquidity enters the banking system. This visualization tracks the M1 and M2 money supply. When a central bank injects money, the resulting wave of cheap capital stimulates growth. When they contract the supply, they starve the broader economic environment. If a central bank aggressively shrinks the money supply to combat inflation, interest rates rise and borrowing becomes expensive. Under those conditions, even fundamentally strong companies will struggle to secure capital or grow their revenue. Macroanalysis doesn't pick winning stocks. It identifies the market's climate, telling the investor whether it is safe to deploy capital at all. Moving from the global economic climate to the defense of a portfolio requires a change in focus. We measure market volatility mathematically, using a value called dispersion. This formula for standard deviation calculates exactly how far historical returns spread out from an asset's average. It provides an empirical risk profile, stripping away the marketing narratives often used to sell a security. Measuring risk is only the first step. You also have to offset it. Investors use correlation as the primary mathematical tool to build a shield against the volatility we just measured. Consider an ice cream maker and a raincoat manufacturer. Their profits move in opposite directions based on the weather. By holding both, their inverse movements combine to form a stabilized trajectory, ensuring a systemic shock won't wipe out the entire portfolio. Statistics act as an investor's shield. Without mathematical diversification, you are simply gambling on the macroeconomic climate. We now reach the granular level of the individual asset. To evaluate a single security, we use two distinct, often conflicting methodologies: technical and fundamental analysis. Looking at this chart, technical analysis focuses purely on historical price action. It tracks geometric patterns like head and shoulders or channel lines to gauge market momentum, completely ignoring the company's underlying business. Fundamental analysis takes the opposite approach. It ignores chart patterns and instead dissects a company's published accounts, the balance sheets and cash flow statements, to find its true intrinsic value. This requires diagnosing the company's vital signs using hard ratios. We track profit margins to prove efficiency, check financial gearing to map debt risk, and use the current ratio to ensure the company can meet its immediate liabilities. This diagram builds the P/E ratio, a core valuation test. By dividing the market price by the earnings per share, it measures how highly investors value the company's ability to grow its future income stream. True analytical rigor often uses both: fundamental analysis to identify an asset with intrinsic value, and technical analysis to decide exactly when market momentum supports the buy. Pulling back from these ratios, the core tension remains clear. An attractive P/E ratio is meaningless if the company operates in a collapsing macroeconomic environment. A professional investment decision demands alignment across the entire funnel: supportive central bank policy, a mathematically diversified portfolio, and a fundamentally sound asset. Even with this alignment, the market produces extreme events that standard models fail to predict. These black swans can violently skew distribution curves, proving that even the best models have human limits. The ultimate goal of this synthesis isn't to perfectly predict the future. The market is, by its nature, unpredictable. Instead, the top-down funnel is a system of survival. It is the systematic application of economic theory and mathematical ratios to filter out noise, measure present reality, and coldly align risk with potential reward.